Welcome to the 2022 Janus Henderson Global Media Conference. I'm Matt Gaden, Head of Janus Henderson's Australian business, and this panel is going to discuss energy transition and commodities. We've assembled an expert panel for you to give their outlook, and they are Noah Barrett, the research analyst who leads on the firm's energy and utilities sector research team, Lomnitzer, a senior investment manager on our global natural resources team, and finally, Matthew Kaleel, one of our specialist commodity fund managers. So to kick off, as parts of the world begin to emerge from the COVID crisis, Tal, you've argued that there is potential for a multi-year super cycle for commodities. What does this mean? And what does this mean for resources equities?
Thanks, Matt. Yes, you're absolutely right. On the resources team here at Janus, we believe that we're at the start of a mega cycle for commodities, particularly future-facing metals that are critical to decarbonisation, like lithium, copper, nickel, steel, aluminium, just to mention a few. The list goes on. Investment bank UBS estimates that over $140 trillion of cumulative capex is required by 2050 just to decarbonise the world's energy system. So you can see that there is good reason to believe that the fight against climate change could possibly be the biggest secular trend for investors globally over the coming years. This is probably exemplified by the rapid rise of EV adoption, with an estimated 83% increase in EV sales last year, taking it to about 7.2% of global car sales versus just 2.9% the year before. But it's not just energy systems and cars, it's also going to need massive investment in reducing the greenhouse gas footprint of food production systems. We're going to need to reduce food waste. We're going to need precision farming, improving animal feed, alternative proteins, all of which are essential to reducing the greenhouse gas footprint from food production. So, I think it's fair to say as a resources team with over 130 years of cumulative experience, we're collectively more excited about the medium-term outlook for our sector than we've possibly ever been.
Thanks, Tal. Turning to you, Matt, I'm interested in some of the remarks that you've made recently about indices. Essentially, is the popularity of metals and resource equities leading to changes on indices? And how's this manifesting itself in the wider market?
And thank you. Yeah, that's a very good question. And as Tal touched upon, there is a decades-long transition that is going to take place here. That will be equally reflected in the way that commodity indices work. First-generation commodity indices that came out 30 to 40 years ago, in hindsight, are pretty blunt instruments in reflecting what is happening in the world. So what we're seeing now and what we believe we'll continue to see is those commodities that will have a greater need to be used in this transition being upweighted in these indices. There'll be changes in constituents as well, new commodities such as lithium. Investors are really demanding a more solutions-driven approach from big index providers and from managers such as ourselves. So that there is a big change happening. It's the quickest change we've witnessed in over 20 years. And we think this is just the start of a solutions-driven approach to constructing a top-down commodity index, which would be very complementary with resource equity exposure. I think starting to see this inflation thematic become more embedded, and investors are starting to seek these things that they haven't had, we believe, the proper exposure to.
Okay, and what's driving this greening, Matt? Are there regional disparities, or is it the global outlier that you could point to?
I think as ESG becomes more embedded in everybody's portfolios, that's also being reflected in commodities as an asset class top down. It's already happening at that bottom up level. And if you speak to the resource teams that we have, they do a lot of analysis and work on the companies that embed that in their processes. At an index level, the index providers are starting to require that. The metals exchanges are starting to require certification that the metals are sourced responsibly, for example. So this is changing at an index level as well, not just at a company level. And that's a crucial thing for investors. They need to know that the commodity indexes that they have exposure to reflect their views and needs. And so, look, as a manager, our role is to keep engaging with the indexes, the exchanges, to make sure that that's being reflected.
Okay, thank you, Matt. Now, Noah, turning to you and to look at here energy and oil. How is the demand for clean energy and the reduction of fossil fuel use impacting the oil market, in your opinion?
Yeah, thanks, Matt. So it's impacting it a lot. Traditional oil and gas companies are under pressure to reduce their carbon footprint, and that can mean several things. So they might be under pressure to divest assets that are kind of disproportionately carbon or emissions intensive relative to the rest of their portfolio. It could also mean that they're asked to slow the pace of future growth projects or just maybe eliminate these projects altogether. But it can be problematic. So if I think about divestment, for example, to me, that's not really a solution. It is for a specific company, but if the assets are still in operation once they've been divested, effectively you're just shifting your carbon footprint from one operator to another. And in a lot of cases, maybe that other operator isn't actually, operating the assets as responsibly as the original company. So the other way, the lever they can pull, slowing the pace of development can work. But if the overall global demand for oil and gas continues to move higher, then you're just exacerbating tightness on the supply side. And so ultimately that leads to higher prices. So it is complicated. I would say most companies, particularly the large integrated oil companies, they do have some type of energy transition or energy evolution plan. And to me, I think the key is, for any company is really trying to figure out what you're good at, what your core competencies are, and what you can leverage when you're investing in new businesses, tied to renewable energy. So right now, you have things like onshore wind and solar, particularly in developed markets. That's a pretty commoditized business, except for cost of capital. Really, it's the returns aren't great. And again, it just comes down to who's got the cheapest cost of capital. So if I'm a traditional oil and gas company, I'm not really sure why I'd be interested in investing there. But on the flip side, I do think that there are areas like offshore wind, particularly on the floating offshore wind side, where that may play into an energy company's strength because they have a lot of experience in offshore markets. Longer term, I think things like renewable fuels, carbon capture, hydrogen could all be areas where traditional oil and gas companies, can have an impact and can invest capital in businesses that'll power them through this energy transition. I just say lastly too, I think an important point, global energy demand, over time it will continue to grow with general population growth and global GDP growth. I'm a big fan of renewables, but I think it's important to remember or to understand that they can't fully displace oil and gas in any medium-term time frame. I think most people, when they hear oil and gas, they think of transportation fuels. But if we put that aside, we use hydrocarbons in an incredible amount of other applications. Plastics, fertilizers, energy input for making things like steel and cement. And the energy transition itself is going to be incredibly oil and gas intensive. It's going to be incredibly resource intensive. So I think we need to take a balanced view and just appreciate that you can't flip an entire system away from fossil fuels in a short amount of time. And so I think, energy companies, traditional oil and gas companies have a really important role to play, over the next several decades.
Yeah, and it'd be remiss if we didn't mention gas. Consumers are clearly paying increased costs for their gas usage. How are you approaching this from an investment perspective?
Yes, Matt, as you noted, we've seen an increase in natural gas prices in several markets, notably Europe and Asia. It's happening. Domestic gas supply in these regions is under pressure, either because one, they don't have the resource, or from a policy perspective, they're consciously limiting production of natural gas. In Europe specifically, they're very reliant on natural gas from Russia, and so if that source of supply goes away, it's significant. I'd say, another issue is exacerbated by, in some cases, by policymakers that are pushing for a pretty aggressive shift away from coal and nuclear for power generation. And so it ultimately it leaves natural gas as sort of the only energy solution for baseload power generation. I think from an investment perspective, I would be cautious about investing in European utilities. As we've seen some government intervention, things like price controls kicking in, and so that makes me a little skittish as an investor. On the positive side, I am pretty positive on LNG. I think it's going to be an important source of energy for a long time, and so I see opportunities in the companies that have large LNG trading operations, or maybe are geographically well positioned, where they have access to a cheap natural gas feedstock that they can then liquefy and send around the world. And then, maybe one final point. I think it's important to understand that spiking natural gas prices and spiking energy costs, they have implications for other sectors too. So, we've seen some industrial companies have to shut in production because their power costs are too high. And so that not only, impacts industrial companies, but then you have sort of the second and third derivative effects that impact consumer tech and other areas of the market. So everything's connected. Higher power prices are felt across the market. And, I think that's something that maybe gets lost, and people want to focus just on oil and gas or just on utilities, but you really have to take a global and market-wide view.
Good. And Tal, turning to you, we've been covering obviously the impact of fossil fuels here. Are there any solutions that could mitigate carbon emissions, and I guess any nascent technologies which you and the team are interested in?
There are indeed, and I wholeheartedly agree with Noah's point about there being an ongoing demand for hydrocarbon for decades to come. And indeed, in the interests of what's become known as the just transition, there really should be. However, having said that, the decarbonisation thematic will continue to roll through, but there can be no net zero the way things are currently look without certain technologies coming through. There has to be, for example, a role for carbon capture, utilization and storage, which we think will come to be quite a significant industry in its own right over time. And there are going to be other strategies as well to decarbonize hard to abate industries, such as steel production or heavy transportation. So we're going to need to see some offsets coming through, and we'll need to see hydrogen emerging as a fuel of choice, perhaps for some heavy transport, or as a fuel source for heavy industry. In terms of other offsets that we're really interested in and think quite highly of, we see reforestation and companies that have involvement in growing forests, and then using that by definition renewable resource, that wood biomass, in construction to replace steel and concrete, which between them account for about 14% of global greenhouse gas emissions, or in the production of plastics used in packaging, or to make those cardboard boxes that we're all so used to receiving from Amazon these days.
Great. And as a final point, gentlemen, where do all of you see opportunities for investors in natural resources in 2022? And I guess which sectors do you think hold the most opportunity? I might start with Matt.
We see industrial metals and natural gas performing extremely well. Natural gas is by Noah and Tal. We believe there's a very good reason to be bullish on that and industrial metals ongoingly.
Okay, thank you. Noah, your thoughts?
Yeah, Matt, I'm very positive about the energy sector. I think oil, and natural gas prices will continue to be volatile, but I think the risk is to the upside, particularly on oil prices. I think within the energy sector, I'm most interested in the upstream companies. We've seen a pretty material shift in strategy, as we've gone through several cycles. And companies now, they're really shifting away from production growth as their main target metric, and they're focused more on free cash flow and returns on capital, and really focused on shareholder-friendly actions. So I think, it makes these companies more investable. Certainly, I think the sector's been shunned. They destroyed a lot of value, over the past decade or two. But on a go-forward basis, I'm certainly encouraged by what we're hearing from management teams, and we're really focused on companies where we think the duration of the cash flow story is underappreciated. Particularly in energy, across the energy spectrum, but particularly in upstream, some of the implied free cash flow yields are really eye-popping. And I think people maybe think it's just a 1 or 2 year phenomenon, and I would say it could last much longer than that. Maybe just another point or another component of the energy sector I think is interesting. I think there's some downstream companies that could be good investments. Thinking oil refiners that have advantaged geographic positions. And so, particularly, for example, the U.S. Gulf Coast, they have access to low-cost inputs. Natural gas is a big input cost for these companies, and as the cost of natural gas rises globally, I think certain refiners, again maybe in the U.S. Gulf Coast, will be structurally advantaged. And then lastly, one point I think the last time certainly oil prices around $90 a barrel get a lot of attention, but the last time we saw oil prices at these levels, the stock prices of many of these companies were much higher. So I think the sector still has room to run. Not only are their stock prices cheaper, at a comparable oil price, but the companies are just much better positioned. Balance sheets are in much better shape. And so I'm really encouraged, on a multi-year basis for the energy sector.
Great. And to you, Tal.
So there's a few pockets of particular interest in the resources sector. You have to be a bit choosy sometimes, and idiosyncratic elements can affect different metals for different reasons. But at a high level, we think uranium looks very interesting. It looks like it could well be part of the green taxonomy that the European Union will be formalizing in the middle of the year as a green activity, as long as it's associated with funded capture and storage of nuclear waste. The uranium mining sector is bereft of new supply after well over a decade of not low investment, no investment. And it's going to be hard pressed to meet any pickup in demand that we might see in a market which tightened considerably last year. We think lithium will continue to be an interesting place. For reasons I outlined earlier, the EV adoption curve is growing at a faster clip than anyone has really assumed it would, and that looks set to continue. Copper has held up surprisingly well in all this macro disruption that we've had, which we think is characterized as a tight industry. So we expect that to do pretty well this year as well. Moving on to other parts of our investment universe, hydrogen as an industry could see some steps forward, in particular around hydrogen electrolysis, and as well as plant-based protein, which has been a high growth area and will continue to be so. And we particularly like companies exposed, sort of selling the picks and shovels in that industry, actually turning the soy or the pea or whatever it is into pea protein or soy protein that ends up in, for example, a Beyond Meat burger. And then moving further up the chain in the agribusiness sector towards animal feed, we see some products in particular for one Dutch company who is about to license a feed that will be given to ruminant animals, think cows, which will be able to reduce their emissions of methane by 30 to 40%. So that's really exciting, particularly for consumer goods companies, like a Nestle, for example, who've committed to reducing their carbon footprint, and whose around 40% of their carbon footprint comes from the milk that they use to make the products we all like to consume. And maybe just a final dark horse to throw out there, might be that barbarous yellow metal, as Keynes referred to it, gold. It's been distinctly weak, and that's because it reacts badly to rising nominal interest rates, and the Fed has been talking pretty hawkishly. Historically, we've seen that once that first interest rate rise or two kicks in, gold can actually perform pretty well. And it may be that the interest rate cycle is a short and condensed one that doesn't bring much higher rates as people think, because economies are ultimately pretty loaded with debt and may be unable to take significantly higher rates. And so once that first raise or two is out of the way, we could see gold hit its stride and pull into something of a bull market.
Okay. Thank you very much for your insights, Tal, and to all of you for those insights. A huge amount covered there by the panel. I hope you enjoyed this panel, and I hope that you'll continue to watch Janus Henderson's Global Media Week panels for the rest of the week. Thank you very much.